What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, a podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name's Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. Hi, everybody. This is Ryan Pulis, and today we're going to talk about the three main financial statements and how they are used to provide you with an understanding of your company or business's financial health. So the three main financial statements are your income statement, balance sheet, and statement of cash flows. These reports to provide you and other stakeholders in your business with important financial information that you can use to make decisions. Your financial reports are essential tools to understanding the company's financial performance, position, and cash flows. They provide a comprehensive snapshot of the business's financial health and are vital for various stakeholders like investors and creditors, management, but most importantly, you. Let's start with the income statement. This is the report most people tend to be more familiar with. So the income statement shows how profitable your business is over a period of time. That can be a month, a quarter, years, but the income statement's taking a period of time and showing you how much revenue and expenses and what's the leftover net profit or loss during that period. So the key components are: one, revenue. This is what you earn for the goods and services that you provide to your customers. Expenses are costs you incur in your business to keep it running. These can be broken down farther into operating and non-operating expenses. Operating expenses are those costs incurred as part of performing your core or regular business activities, things like rent, equipment, insurance. Non-operating expenses are those expenses incurred for reasons that don't directly relate to your primary business. For example, interest on debt is typically a non-operating expense. At the bottom of your income statement, we'll have net income. This is the net income or loss is the total money the business earned for a period after accounting for all expenses in the period. A positive net income increases the company's equity, while a net loss decreases the equity in a company. If you're selling goods, then you'll typically see a cost of goods sold expense that comes after gross revenue. This is deducted from your revenues to show gross profit. Gross profit is the profit a company makes after deducting the costs associated with making the product or selling its services. So it's calculated by deducting cost of goods sold from the revenues for the period. After gross profit, you'll typically see the company's operating expenses. These total operating expenses are deducted from the gross profit to arrive at net operating income. Operating income is an indication of the business's earning power. Following operating income, you'll see your non-operating expenses, which are then deducted to arrive at the net income or loss for the period. This is your true bottom line and represents how much money is left over for the period after factoring in all your expenses. The net income or loss for the year gets closed to retained earnings at the end of the year, and all the accounts on the income statement are zeroed out. So we refer to those accounts on the income statement as temporary accounts, because at the end of the year, they're zeroed out to retained earnings and you start fresh in the new year. Retained earnings is a balance sheet account in the equity section. So now let's discuss the balance sheet. Balance sheet shows the financial condition of your business on a specific date, usually the end of the month or a year. While the income statement shows income for a period, the balance sheet shows your company's net worth. As mentioned, the income statement accounts close to retained earnings at the end of the year, which is a balance sheet account in the equity section. Your balance sheet accounts are permanent. We mentioned income statement accounts are temporary because they close out. Balance sheet accounts are permanent because they continue on from the beginning of the company to the end, or until the account's no longer used. The key components of the balance sheet are assets, which represent the things you own or your company owns. Current assets are typically shown first, followed by non-current. Current assets are simply those that are expected to convert to cash within 12 months. For example, your accounts receivable. Generally, you would expect those to be paid in less than 12 months, so we list those under current assets. Non-current assets are those things that are expected to last for more than a year. For example, computers or equipment, automobiles that the company owns, buildings, Those are your non-current assets. Now, while assets represent what the business owns, liabilities represent what the business owes to others. So similar to assets, liabilities are shown with current liabilities reported first, followed by non-current liabilities. So an example would be accounts payable is an example of a current liability. You're expected to pay those off within 12 months or less, while a non-current liability may be something like a note payable for the loan on your office building. After liabilities, we have the equity. So the equity is what's left over for the owners. So your owner's equity is simply assets minus liabilities. The owner equity accounts contain the retained earnings account. This is where the net income and loss close out at the end of the year. The retained earnings simply represents a running total of all the prior year's net income and losses. So the balance sheet follows a pretty basic equation, and it's assets equals liabilities plus owner's equity. The two sides must balance, hence the name balance sheet. The main idea behind the balance sheet is that the business must pay for any assets that it acquires. And how it pays for that's going to come from either borrowing, which represent liabilities, or from being funded by the owners. So the owners can contribute capital, or the income from operations, which close to retained earnings, is another way to help finance the assets the business owns. So our balance sheet shows us the assets the business owns, to who the business owns any debts or liabilities, the amount left over for the owners and the owner's equity. And our income statement is showing us the operations and how the business is generating income and money to help fund the business. But what it doesn't show us is where all the cash goes. This brings us to the cash flow statement. The cash flow statement shows how much cash is flowing into and out of your business. So neither the income statement or balance sheet alone give us a clear picture of where the cash ends up. So we use the statement of cash flows to tie together all the cash movements. You've heard the expression cash is king. So knowing where the money and cash in your business is flowing is vital to understanding the health of your company. There are three main sections of the cash flow statement. We have the operating activities, which represent incoming and outgoing cash from normal business activity. This typically starts with your net income or loss for the period and adjusts for changes in current assets and current liabilities. Next, we have the investing activities, which show the cash movements related to investments your business is making, such as investments in long-term assets or investments in other businesses. This section shows the change to non-current assets. Third, we have the financing activities. This shows all the cash flows from activities related to financing your business. It shows you changes to non-current liabilities and to equity. So this is where you would see changes to long-term loans. We'd have owner contributions and owner distributions would be picked up in this financing activities section of the statement of cash flows. And then at the bottom of the statement of cash flows are summary lines which show us the changes in cash from operating, investing, and finance activities, and it reconciles this to the change in cash from the beginning of the period to the end of the period. The three financial statements, income statement, balance sheet, and statement of cash flows, are interconnected. As we've mentioned, net income or loss closes to the equity section of the balance sheet at the end of each year, and the cash flow statement reconciles beginning cash to ending cash on the balance sheet, and generally starts with net income in the operating section and adjusts for changes to current assets and current liabilities. So it's important to use all three financial statements together to really gain a clear understanding of your business's overall financial health. Each statement alone provides some useful information, but when they're combined, you really get a complete financial picture of your business. So to recap, there are three main financial statements. The income statement, which shows how profitable your business is over a period of time. The balance sheet, which shows the financial condition of your business at a specific point in time. And the cash flow statement, which, as the name suggests, shows you the inflows and outflows of cash in your business. It's important that you, as the business owner, understand these financial statements, how they interact with one another, and what information they're actually providing you. In a future podcast, we'll do a deep dive into each of these financial statements and to give a little more detail of each one and what information is presenting to you. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.